you are, say, aggressive investor who has a very long-term horizon, you could look at maybe, investing about 60 to 80% of that in large and mid-cap equities, in mutual funds mostly. And the balance you can look at investing in international and fixed income. If you're looking at, say, retirement sort of a thing, then maybe an equal allocation towards large, mid, small is an excellent strategy for an aggressive investor. I wouldn't recommend stocks to new investors unless if you have an extremely long horizon, say 5, 10, 15 years. And even there, I feel like if you look at the index today versus the index 15 years ago, the index 15 years ago used to be very different. They used to have 20 years ago, they used to have infrastructure, utilities. Today we have IT, and tomorrow there might be something else. So I think a stock investor needs to constantly think about what's next. The portfolio needs to be relevant for the times, which require and honestly the times change very quickly nowadays. Quant investing. So we currently have 2 verticals, active and passive. Now we're looking at scaling up a 3rd vertical, which we set up about 3 years ago. We believe that quantitative investing can be a big opportunity. There's no strategy in the world that outperforms in every market condition. In Warren Buffett has a national with that. So I think you have to be very patient.
So Pratik, if you had to allocate 100 rupees today, how would you do it?
It's a very good question. I think it's a better question than what category or what fund to invest. The reason why I say is because for a new investor coming in, I think what's important for the new investor to realize is that if you are investing, say if you're investing for 10 years, what determines your long-term returns? It doesn't really matter if you buy this fund versus that fund. What really matters is your allocation towards your different asset classes. And this concept is called asset allocation. So I think for a new investor coming in for the first time, they really need to know what their asset allocation is going to be like. And I think that happens with your risk profile. So for any new investor coming in, I think you should be absolutely clear about your asset allocation. That should be determined by your risk appetite. So I think that's very important. So suppose you have 1,000 rupees today, and if you are, say, aggressive investor who has a very long-term horizon, you could look at maybe investing about 60 to 80% of that in large and mid-cap equities, in mutual funds mostly. And the balance you can look at investing in international and fixed income. If you have 5-10%, then you can also look at investing in gold or silver. So I think that's a very good allocation to have because what we also believe is that having your eggs in multiple baskets, and by baskets I don't mean different funds but different asset classes, you are essentially removing a lot of volatility from your portfolio. So I think have an asset allocation, invest in multi-assets, and invest as per your risk appetite.
I noticed you didn't say small cap. So has the rally gone too far?
No. So I think small cap again is for someone who has a higher risk appetite. I think that small caps today are behaving like mid caps of yesterday. An average small cap stock today. So when we launched our small cap index fund in 2019, an average small cap company was 4,500 crore. Today, an average small cap company is around 25,000 crore, which is similar to what a mid-cap company was maybe 5-7 years ago. So I think you can't attribute the same risk to a small cap as you did 5 years ago.
Right.
So in fact, I feel the opposite, where more people should adopt small caps today than people say 5 or 7 years ago, because they've become a lot more mature. In fact, even mid-caps, mid-caps today, our average mid-cap company is 60, 70, 80,000 crore. That's huge companies.
Yeah.
They are behaving like large caps. So I think it's imperative that people today not only stick to large caps, but at least if you're conservative, you can look at large and mid caps. And then if you're aggressive, you can also look at small caps. But as I said, it's not as per the rally or anything. It's as per your risk appetite. So if you're able to take a little bit more volatility, go for small caps.
Yeah, so you laid out 60 to 80% in equities.
Yes,
so
if you are an aggressive investor.
Sure.
If you're able to take the volatility, if you're able to take drawdowns, short-term drawdowns.
Sure. So within this, if I were quite aggressive, how much would I put into small caps?
So if you're extremely aggressive, then I would say, honestly, I think, again, it depends on people's goals. But if you're looking at, say, retirement sort of a thing, then, maybe an equal allocation towards large, mid, small is an excellent strategy for an aggressive investor. So maybe 30% large, 30% mid, 30% small. that sort of a strategy works very well, and then you keep rebalancing it depending on performance.
Through the mutual fund route, of course.
Through the mutual fund route. So I don't recommend direct stocks because, at least for new investors, because direct stocks, unless you're a full-time investor, it's very hard to make money of direct stocks. Unless you are putting in, say, every day, whereas in mutual funds, you have professional fund managers whose daily job is to determine which stock to buy, which stock to sell. So you're relying on their expertise. They're not very expensive. Or you can just look at index funds, ETFs. Personally speaking, I wouldn't recommend stocks to new investors unless if you have an extremely long horizon, say 5, 10, 15 years. And even there, I feel like if you look at the index today versus the index 15 years ago, the index 15 years ago used to be very different. They used to have, 20 years ago, they used to have infrastructure, utilities. Today we have IT, and tomorrow there might be something else. So I think a stock investor needs to constantly think about what's next. The portfolio needs to be relevant for the times, which require, and honestly the times change very quickly nowadays. So I think mutual funds are a lot more suited for most people.
And what should be the active passive breakup in this?
It's very hard to give one breakup, but I would say today most people have a 0% allocation towards passive. So I would say have maybe some allocation to passives. What we suggest is to have your core allocation and passive. Core allocation is the type of allocation which you will never touch for a very long time. Passive, the beauty is that it's low cost, there's no underperformance, and I think the returns are pretty much on par with most active funds. So I think it's a very simple way of investing, and I think it works very well for part of your portfolio which is extremely long term. Say suppose you had to invest for your retirement, which is say 25, 30 years from now, what fund will you invest in? I think passive fund makes sense because you don't have to worry. The S&P 500 has been around for half a century, and continues to be a very good fund to be. So I think it makes sense for your core allocation. It makes sense for the part of your portfolio that you don't want to touch for a long time. And I think globally, if you look at most portfolios, they tend to be about approximately 40-50% passive, 40-50% active. So but maybe for most investors, 20 to 40% makes sense.
Now, very interestingly, you guys launched the microcap index fund almost a year ago, I think.
Yeah. I would say in August of last year, July of last year.
And it has done, the index has done extremely well. I think 55% has been the 1 year.
Yeah, 1 year has been more than that. This history launch has been 55%.
I must admit, I was also a little apprehensive about about being able to guarantee liquidity in that space.
Yeah.
Of course, the caveat here is that bull market has still continued. So we haven't yet seen a withdrawal of liquidity, a turn to the bear market. And we've seen signs from various quarters, including SEBI, about will MFs, not just microcap, but small cap also be able to manage liquidity, and so that stress testing framework and the rest of it. Have you put in place more measures to ensure that you have liquidity if tomorrow the market turns, if you face a lot of withdrawal? How would you deal with it?
Our fund is not very large. It's 1,000 crores. I think the stress test comes into place when your funds are extremely large. The category is very large. There is no micro-cap category in India. There's small caps, and small cap category is very large. That's where most of the money is going in. So I think, and that's where you have funds which are like 30-40,000 crore, which are very large. So I think we don't feel the need to, we've obviously, because we're an index fund, we unfortunately, our job is to just replicate the index and nothing else. So we are doing that. And the beauty about having a micro cap index fund is that the top 10 stocks, it's very equally distributed. So the top 10 companies are like 11-12% of your portfolio, maybe less than that also. I think it's almost like an equally weighted sort of an index, and you're buying 250 companies as opposed to say 50-100 companies. So I think it's a well-designed index in the sense that it's pretty much very equally weighted. The largest exposure is not that large in terms of, and we are obviously tracking daily volumes, and we are seeing volumes grow up.
What kind of volumes do you have currently?
So we're seeing volumes that are close to 10 to 15 times that what we have to buy and sell on a daily basis.
Right.
On when we have good big flows. So I think there's a lot of volume in the market, and it's increasing. So in fact, post launch of the fund we launched, the weighted average volume has gone up 3x. The volumes have gone up 2x, and this was about 3 months ago. So now it's probably gone up even more. So I think, and also as I said, the average size of the company is also quite large. The largest holding is 12,000 crore.
Yeah.
Post we launched, I don't know what happened, but the market depth has increased,
Yeah.
which has helped us. In fact, we were looking at closing the fund at 400, 500 crore for lump sums.
Yeah.
But we're seeing very healthy volumes today. We can easily do a rebalance up to 300 crore on a day.
In a day?
In a day, yes.
Wow.
Yes. Throughout the day, in fact, I mean, this is a bit technical, but the problem is not rebalancing. The problem is, so what we do in index funds is that we have to match your end of day price. So a lot of our transactions happen in the last half an hour. So if we get a big transaction, which is buy in or sell out, that becomes a lot more difficult than buying throughout the day. So that's where we have to be a bit careful. But that's a bit technical.
You mean the market making? So you have to...
Not market making, we have to basically match the end of day price.
Okay.
Right? Something called it's called VWAP, where we have to buy certain quantities every minute till close. And that is to make sure that our price is close to the end of day price. So if we get a very large transaction, large inflow coming in, spreading that large inflow in the last half an hour becomes sometimes problematic.
But when you say you mean the market maker that you engage?
No. It's index fund, so we do it ourselves.
Okay.
So then ETF, they are the market
that's
maker.
where it comes. Right.
Because this is an index fund, we have to basically make sure that our prices are close to the end of day price. This is to reduce tracking error. So
Understood.
That's a little bit more complicated, but so far we haven't had issues. But yeah, I think it really depends on the market. So we are monitoring the market on a daily basis. And when we feel that, you know what, this is getting difficult for us, or this may become difficult in the next few months, then we'll obviously maybe close for lump sums.
Okay.
We want to be open for SIP investors. So that's sure that we're very confident about.
Let's turn to another of your passive products, which is probably the most successful passive product that you launched, or in fact, arguably that is there in the industry, which is your NASDAQ ETF. 2011 is, I think, when you launched it.
Yes.
Now, of course, the issue with all international feeder funds is the limit on international flows. Yet, you haven't hit that limit yet. So you still are able to accept money, which might last for a few months, right?
Yeah, so we don't know. We can't say might last for a few months, might last for a few years. So it really depends on inflows and outflows. But yes, we have some limits still. So we're able to build market on a daily basis. In fact, last 10 days, we've almost created new liquidity worth 40 crores on the exchange. So far, we're managing the fund. We're making sure that prices are efficient. Post the SEBI ban that came in 2022, for 3-4 months, we couldn't do market making. But then after that, there was some clarification. After that, we started again. So and post that, the prices have been very efficient. So we're doing a good job on making sure that the prices on the exchange are reflecting the underlying stock basket.
Can you tell us more about what you're doing in GIFT City, both in terms of domestic investors trying to diversify internationally and NRIs who want to invest in India?
Yeah, so we're seeing a lot of demand for Indian equity, especially in the last 1 year. I think Indian markets have done well, but also I think there's a lot of optimism around investing in India, and even the FI flows have just increased a lot over the last few months. So I think we are seeing a lot more traction happening from global investors who are looking to invest in India. And unfortunately, there's not a lot of vehicles that allow that. Obviously, you have Mauritius that used to be was under tax treaty. Now it's not. So I think now GIFT City has become or will probably become the dominant way in which AMCs, wealth houses can accept foreign money into Indian funds. So I think it's become very strategic, and obviously we have been operating there for the last few years. We have an office, and we have already actually raised capital from there for some of our private equity funds, and we're looking at also setting up a mutual fund arm out there, where we already have one fund live. We're looking at adding a lot more funds.
But that's in the AIF format, so
no, even mutual fund feeder format. So looking at allowing offshore investors to invest directly in our own mutual funds. So that's a feeder structure which we're also setting up. Hopefully we'll get approval on that over the next few months. We're also looking at GIFT City from an offshoring perspective as to how do we use GIFT City to provide simple solutions for investors to access capital markets outside of India. Right now, LRS is obviously very complicated and very expensive as well. So we're working. So right now, I think there's some lack of clarity on certain regulations and tax stuff. So I think that'll probably take some time. But yes, we have very strong intentions of using Gift City for inbound as well as outbound. And I think it can be very strategic for the organization as well. As more and more interest is coming for Indian investors looking to diversify, as well as offshore investors looking at investing into India.
So Pratik, as an AMC, can you tell us a bit more about what you have planned in the coming year?
Yeah, so our AMC is, obviously we've had a huge sort of resurgence over the last 1 year. I think in all our businesses, so we're currently at about 75,000 crore in assets that we've grown from, I think, 45 in the last 1 year. So we've had a very good amount of healthy growth.
Of which you said 1/3 is passive.
Yeah. Almost 1/3 is passive. So I think that also business has grown dramatically and their flows have just, really gone up. I think in terms of awareness for passive funds have gone up tremendously. There's a lot of broad-based demand coming in from all channels. So before it used to be very direct, very lumpy, but now we're seeing, good SIPs, lump sums, all channels. So I think in that sense, that business is obviously doing well. We've also had a huge recovery, or also even most of our active funds, which is obviously a dominant part of our business, AIF, PMS, and MFs, have also done extremely well, and they were looking to scale up that business dramatically over the next 2 years. So I think overall, we've obviously have a new CEO in place, a new CIO, and under the leadership, we've seen a huge, comeback. All of our funds are in a top quartile. So I think generally we're seeing a very positive momentum building up for entire business altogether. Obviously, we talked about Gift City, which is going to be very strategic. We're looking at launching a couple of funds this year on the active space. In passives, we have currently about 35 funds. We're looking to launch about 10 to 12 of them, 12 new funds this year itself. So there we have a huge pipeline of funds coming in. We're hoping that internationals open up. So we have a few funds there also that we are looking to launch. And also on the customer front also, we're obviously getting a lot of traction from new customers coming. So overall, I think as a business, we're not looking to do anything dramatic, but just continue on sort of following this path over the next 3 to 5 years time. The only new thing that we are pursuing is quant investing. So we currently have 2 verticals, active and passive. Now we're looking at scaling up a third vertical, which we set up about 3 years ago. We believe that quantitative investing can be a big opportunity in terms of, it's already a big global opportunity. I think 6 or 7 of the largest funds in the world, hedge funds, all quant shops. And we do want to, I wouldn't say replicate, but, get success from an Indian perspective in those funds. So that's going to be a big big initiative for us this year. And that is something which I think investors will hopefully see a lot more.
Right. Just to clarify for our viewers, that's in the AIF space, not?
That's in the AIF PMS space. So that's again very for alternatives. I think that offers those structures offer us a lot more flexibility for us to really launch funds. So yeah, that's going to be in the alternative space. Again, very H&I type of products.
If you had to name one personality as sort of the investment guru or style that you follow or respect the most, what would you say?
I'm obviously very biased by my brand. So I think, obviously Ramdev ji would be the first person and he'll also be the last person in my head. So I think grown up around him and all of that. So I think really believe in the style and strategy. And I think the good thing about our AMC is that we're also an AMC that is continuously learning, continuously adapting. We're very focused on research. I don't know if there's any other AMC that puts in the amount of work that we do in really understanding, analyzing, going deep. Even our tagline used to be, solid research, solid advice. So we're a very research-focused company. Most of our individuals are very research-focused, and we believe that the power of knowledge is the strongest type of knowledge you could have, especially in an industry like financial services. And we really harvest that in a very big way.
But this was before Buy Right Sit, right?
So Buy Right Sit was a mutual fund. I think overall group was solid research, solid advice. Right. After that, it become Think Equity, Think Motilal, which is what it currently is.
Right.
I think we stand for equities. We believe that we really understand that space really well, and we've been doing it for 35, 40 years, and I think we will continue to do it for a very long time. And what I've also realized is that there is no style that works across different market conditions. So it's very important, when investors invest in any funds that is managed by a fund manager, investors tend to be very unforgiving, So and they tend to churn portfolios based on performance. It's very important to understand that there's no strategy in the world that outperforms in every market condition. In Warren Buffett hasn't managed to do that. So I think you have to be very patient, and you have to believe in the philosophy, and you have to believe in the fund manager and all of that. So I think it's very important to really look at stuff outside performance for you to make long-term decisions. And I think that's why, it's important to stick to a philosophy as opposed to keep on churning philosophies.
Fair enough. Pratik, thank you so much. It was lovely speaking to you.
Thank you so much.